Thank you very much. I'm going to talk, but the Chief Exec and Katie are in the audience. Difficult questions for them later, please. And they will also talk about their business to anyone that wants to. Before that, they have to listen to me talk about their business. I'll be suitably rude. No. What will be different about this presentation than Abbas just now is you have to realise this is an investment trust. It couldn't be anything else. It owns 100%, it owns its own business, the professional services business, and it has 80% of its assets in a portfolio of shares run by me and Laura at Janus Henderson. This structure, I think, I'm going to try and convince you, has real merit, but it is unique and can only be done in investment trusts. And because, as an investment trust manager, I'm feeling pretty beaten up at the moment with people keeping telling us how sleepy we are and how awful our discounts are. Well, it's got no discount. It's trading around asset value and has for a long time. So some of the criticisms are unfair. You couldn't do this in the open-ended space. Why couldn't you do it? You can't own 100% of a business that's 20% of your assets. You can't do it. You can't do it in most products because you wouldn't have the liquidity. But the closed-end structure is really good for an investment manager. It allows us to take long-term views. So it's rather nice starting with this slide. This has been going 135 years, long-term view. It started and has grown over that time by being an investment company with a closed-end structure. We do issue shares. When the premium is when there is a premium and there is unsatisfied buyers, but on the whole, it's closed end. So I know how much money I've got to invest, and that is so much easier than in the open-ended space. I'm not looking over my shoulder. I can take a view about a small company, and we have a small company holdings in the portfolio, and I don't have to think, am I going to sell it tomorrow? I haven't got the business manager coming down to me and telling me the liquidity in this share is too long, we can't hold it, which you can't in an open-ended structure, but you can in this structure. We've got to make it count. We also have borrowings. We are 12% geared at the moment. Again, something you couldn't possibly do in the in the open-ended structure. You could only do it in the closed-end structure. And I'll finish with just one other point. The charges are, we're paid the miserly amount of 0.3% for managing it. Our open-ended stuff, and as with everyone else's, would be more than twice that. So for all those reasons, I find it irritating at the moment for the press to keep saying what a sleepy, useless industry we are and that we need Saba kicking us up the backside the whole time. We don't. There's a lot good and lots of good things happening in this industry that has given very good returns over very long periods. So much for the advert. What is Law Debenture? It is 81% of the NAV is what you would know about, is what Laura and me do, and 19% of the NAV is Dennis's business. And that is a really good marriage from my point of view. That 19% actually produces a third of the income that gets paid out in dividend. So Laura and me start the year more or less knowing that a third of the dividends are already coming in. So our portfolio, we can buy things with zero yielders, and we'll show that later, that we can make that thing count and still have a high yielding company, a decent yielding company. It's given us the combination of the two means we can have more dividend growth in our bit than other high income funds in the sector, and that's why we've had much better dividend growth over time than the rest of the sector. Now, this is the bit where I should really pass over to Dennis, but for the sake of time, he's going to have to listen to me on it. And I can say this, I've been going along to Law Debenture since 1992, when Henderson's and TR merged. And it was all actually, their business was all slightly a black box. I never quite understood what it did. In those days, I had to sit through all the board meetings, so I should have understood, but I wasn't very... But with the new management team of recent years, it has become much clearer and transparent. The three businesses, we're getting their revenue, something we never used to get before. We get their growth each year. There are 3 businesses that are all part of the overall mission, which is a trusted third party in the city. And the trustee for pension funds, corporate trust, and corporate services. And they're a blend of businesses in themselves. Sometimes a bit different businesses have their moments in the sun, like in any portfolio. And their business, I sort of knew this, because I used to, when Mrs. Truss' budget went all haywire, and pension funds didn't know where they were, I went round to their offices, and they were running around quite a lot, because they're trustee to pension funds. I knew something must have been happening then. Of course, it was good for them. They charge they charge for their services, and companies, pension funds were in a difficult place at the time. They needed advice. Therefore, in that year, that's why the profits spiked up that year, and it comes down a bit the following year. But you can see the growth. But every so often, you get a bit of cream. The same in the corporate trust business. But for more details of it all, you need to talk to Dennis and Kate, who are in the audience, and I know they enjoy, and I hope you'll have a bit of time, because you'll get the full story from them. But how does this all translate? This translates into, these are 10-year numbers. We could have given 25-year numbers. We could have given 135-year numbers, and you'd have seen strong growth between the mix of these businesses. The share price over this 10-year period has outstripped the assets because, as I say, the discount has been eroded. Before that, sometimes the fund used to trade at asset value. It goes up and down, but in recent years, the share price and the total return have been the same, because it hasn't been, the discount disappeared. But this is a breakdown of the businesses. This is so much more transparent. There used to be this black box, and no one understood. We're now lifting it up, and we're being shown what's happening in that business and its long-term growth. And for us, it's come back to it. It's very cash generative, their business, and it's that cash that comes through to you as shareholders. That is 20% of the business, and it has taken me 7 of my 20 minutes talking, so about right. And now onto the bit me and Laura run. We unashamedly run a long list of stocks. Dennis they've got a really good business there. I'm not going to mess it up with big stock-specific risk. But we are going to run a long portfolio because we want genuine diversity in that portfolio. So it's predominantly at the moment UK, 80% or so UK. I've been low as 55. I've been up to 82.3. I'm at the high end of the UK weighting at the moment because Laura and me are natural contrarians. We've been selling America for a number of years, too early, some of it looks all right now. But we've been moving out of America, selling. Actually, the Far East is quite low now, but we will re-examining it. That's really got me thinking about it. We can go there. We will go there. We've got teams that can look at these things. We can always go to investment trusts if they're on big discounts to buy it there, and we do buy other people's investment trusts. One bit of advice I always got was never be proud in this game because you're about to be kicked up the backside. And it's true, I'm not proud. So if I see somebody doing something better than me, I buy their trust. We've got Katie Potts Herald, for instance, at the moment. She does things we could never do. We have it in the portfolio. It adds to the overall diversity, mix and growth of the portfolio. We have a selective bottom-up approach. We are fundamentally value orientated, and that's what's pushing us more towards the UK at the moment. The 5-year number looked nice, but this is the 1-year number, which you saw solid outperformance over the 1 year. What did it? Well, I'll put in this slide, the next slide shows the same thing. For an income fund, it's unusual to see a share that's not paying a dividend as your major contributor. Actually, that doesn't pay a dividend either. Flutter and Rolls-Royce, but because of Dennis and because of the trustee business, we can buy zero yielders before they come back onto the dividend list or come onto the dividend list. That means it gives us capital growth. And I just a little bit, another bugbear I have about people talking about the investment trust sector at the moment. They're telling you that the way you must get rid of discounts and things is shove your yield up. Just shove your yield up and your discount disappears. A true dividend comes from the earnings. It shouldn't be more than the earnings of what you've got underneath you. Otherwise, it's capital that's being paid out to you. And I do remember my dad always being very strict with me, always strict with me. He says, James, the way rich people become poor is to confuse capital and income. If you're short of money, if you're short of income, and you don't think you can just sell some capital and you'll be all right. If you keep doing that, you chip away at your capital until you've got nothing to produce income. That's how the rich become poor. And that's sort of what we're seeing in the investment trust sector at the moment. We're seeing people hike up their dividend, but they are actually capital. They're chipping away at their capital, and their capital base is shrinking, and therefore in time they'll have less income to pay out. With Law Debenture, it's a well-covered dividend, and it isn't the highest dividend in this sector, but I say it's got the best dividend growth, because if you have a little low genuine dividend, and you grow the capital, then your income can properly grow, and that's a sustainable real growth of dividend. So that's why having zero yielders that give you capital growth, when you take profit in the area, and we have reduced Rolls-Royce, we have reduced Flutter, we have reduced Marks and Sparks, another company that came on before it paid a dividend. When we take those profits, we can reinvest them into things sometimes that are paying dividends. So your pool of revenue grows, and that's what really grows a sustainable dividend. I've gone on things that have gone right. I must go on a few things that go wrong. We do buy some early stage companies. Some of the early stage companies stay early stage. That's investment for you. But that's why we have a long list. I still think some of the alternative energy stocks, fuel cell companies, it will happen. It will happen. And some of them are beginning to grow traction. Actually, what's nice about those 5 detractors from an investment point of view is that they're all 5 very different companies that were the detractors last year. Vanquis, Rio, you know, Vanquis is an unsecured lender. BP's BP. Next 15 is a communications company. So different things went detracted last year, but it was a 15% up year and a year of reasonably ahead of the index. Because of these stocks, really. So over 5 years, again, I put this in just because it's for an if you've been too focused on yield, if you've just stretched for yield in the UK in recent years, you haven't performed as successfully as the lower yielding area has been better, and that's why the mix of having Dennis's business producing cash up to holdings has allowed us to have these lower yielding shares. Ceres looks odd there because it's 60p and it was 60p 10 years ago. That's because it went up to £16 at one stage. We did sell quite a lot. I'm afraid I didn't sell them all, and actually we've been buying them back recently. It is a better company than it was 10 years ago. It was much better company than when it was £16. But it's a fashion business, this, and hydrogen got overhyped, and now it's the other way. Flutter, that's Betfair, it's American, reducing that a bit. We haven't got any applied, we haven't got that. We sold all the Croda, we've been reducing that, and we haven't got that anymore. My point being that we are contrarian. When things have gone up a long way, we re-examine them, and if if this gets a bit of hope in that share price, we will rotate out, and things we're buying, we don't think there's less hope in. There's no less hype in. But we believe the people are being unduly hard on those companies. The ones that people are thinking are doing so well. Things are never as good as I'm told, usually. Things are never as bad as you're told either. And that's what a contrarian always has in his head. Yes, Rolls-Royce is a wonderful company, great technology, but the management don't walk on water. And we have to be careful. We have to be careful that the hype doesn't go far past the facts. And they've done so well, and it has been a great UK turnaround story. But you just have to be careful not to take these things too far. So we've halved the holding, and we've reduced it a bit further now. It's still 2.5% of the fund, because it is the best technology share really in the UK in its way. You always see this chart. The UK, the cheapness of the UK. This is why we've been selling America for a bit, and got America down to 5% now to buy the UK, because the UK multiples are so a rock bottom. And I liked some of the charts from Amos's presentation. And actually, funnily enough, I was told this morning there's a very good investment committee at Law Debenture. Another thing investment trusts have over other competing products. It's a really strong investment committee, and one of them told me this morning, James, you really need to look at opportunities in the Far East and emerging markets. And we've got teams that will do it. They've got graphs down there too. We will look, and it won't be a big part, but if we see opportunities there, we'll act. But at the moment, the focus is the UK. The UK is cheaper now, and I've been working at Henderson since '82. This is the first time I've owned a portfolio that's actually on single figure P next year that's going to see the earnings growing. And that's something. The yield on the portfolio is higher. The portfolio yield is higher than when I started, yet that period was a period, last 25, it's more than that. Christ, I've worked at Henderson now 40 years, and in the last 40 years, this is the cheapest we've seen, yet the returns over those 40 years have been very good from UK equities. We must remember that. What are we buying now? Got 3 minutes to go. Diversity. Different sorts of companies. Greencoat Wind, 40% discount, 48 power wind turbine farms in the UK, onshore and offshore, yielding 9 with a dividend that's growing with RPI. It's oversold. AB Foods, it's kind of share that the market's having real trouble with AB Foods. It's British Sugar, for instance, is always volatile, its earnings. Doesn't make it a bad business. It'll have years when sugar prices are low and it doesn't lose money, it doesn't make very much. The market has real trouble valuing that kind of thing, but it's a great franchise. British Sugar is a great company, regardless of 1 or 2 years' earnings difficulties. So if you can, at the moment, you have to be showing upward earnings revisions to get a following. Therefore, it gives an opportunity to buy AB Foods. British Sugar will recover, as will Primark. We're taking profits, as I said, in a few things. The list of the top 15 holders. The other thing you might notice, these aren't big hold percentages. It's a long, diversified list. And we are going to just try and do more of the same, buy good businesses when they're modestly out of favour. We're going to run with a long list. We're going to be modestly contrarian, hopefully not contrarian for the sake of being contrarian and difficult, but contrarian because that's where the value and the opportunities are. And that's a long-term chart. And as I say, the portfolio was more expensive down there than it is up there. And that really mystifies me, to be honest. So, and I've finished. I've learnt from the first speaker to finish dead on time, so we've got 10 minutes for questions.
Thank you very much, James. Thank you. Okay. If there are any questions, please raise your hand and wait for the microphone. Chris, yes, please. Chris? Yep. Gentleman here. Thank you. Yep. Go ahead.
Very interesting talk, thank you. I do appreciate that you're very different from your competitors. One thing that baffles me, though, is that 19% of your company generates a third of your profits. Wouldn't it make more sense to have a greater proportion of that company than the 81%, because it would create more overall? And would you say you've been a dividend hero? Do you have a record of increasing dividends over long term? Thank you.
We had 1 year, 2008, we didn't increase the dividend. The banks were crashing and everything else. And I remember the meeting, just held the dividend. I mean, it was everything was noise round us. And if we'd only put it up a quarter of a penny, we'd have had the dividend. But to me, it's a good marketing thing that over-focus on that, in my view, sometimes. They've got 100%. They own 100% of the professional services business already. So it will grow, and hopefully over time, and it will become, if it outperforms the portfolio, will become a bigger part of the overall cake. And they're investing in it. And I think one of the things is great going around there. You feel a real buzz in their business at the moment because they are investing and growing it. And it will grow at whatever it will grow at. Time will tell. But it's an exciting place at the moment.
So just on the dividend, James, is it the policy to increase the dividend?
Yeah,
apart from that year?
Definitely. 2008, it was held, but it's been grown every other year. And the intention is to grow it with the earnings going forward, and that's what it's been doing. Yes, thank you.
Question at the back? Yep.
Can you please explain how you factor in the low GDP growth in the UK into your thinking?
Oh, thanks. Yes, and sorry, it's awful to have stood here and not talked about tariffs and everything else. I think the thing is we're not buying the UK economy. We're buying, rather like Abbas was, we're buying companies. We're not buying an economy. There are good businesses in the UK, and those businesses are global leaders. You know, we go down that list. Companies like Rolls-Royce is very good. Flutter, actually, there was always a good gambling culture in England. Betfair was always, Paddy Power and Betfair were really imaginative, good places to go into, whilst America was always so dull. American gambling, really boring. When you had the flair of Betfair and out there, that's where it came from. That's its breeding. Flutter, it doesn't surprise me. Flutter is doing so well as American gambling opens up. You know, so yes, maybe not the most glamorous industry to say we're very good at, but the UK is very good at gambling, the gambling industry. We've got some financial services companies that are absolute leaders. Actually, I've been buying Schroeder shares recently. It's extraordinarily cheap when you compare it with an American fund management group, and it's got some able people there too.
Any questions for James? Question here, please, Steve. Yep, thanks.
You're probably going to refer me to Dennis, but given the angst over the UK stock market and the stock exchange and companies delisting, the reduction of the size, how is the services part going to grow? The two seem to be in conflict. You're telling me everything's good and they're growing the business and it's going up. How can that be when all we're hearing is how poor the UK stock exchange is doing globally? And
I think Dennis has got a loud voice, so I'll get him to do it. All I know is that they do a lot of red tape in the UK, and they're the people that make the red tape manageable.
Question your microphone down for you, Dennis.
I think, interestingly, if you look at where our income comes from, it's probably less, as a governance services organisation, it's probably less off of equities and more off of bonds and other asset classes. So we run a big pensions business. Doesn't really matter, equities, bonds, other assets. So doesn't, in the nicest possible way, I'm not thrilled about the structural problems that the UK has, but it doesn't really feed into the amount of revenues that we're making there. In the corporate trust business, that feeds off bonds, and then we've got other businesses, whistleblowing corporate services, where I hear your point. It's something that we need to fix structurally for the UK, but with respect to our professional services businesses, really doesn't have a huge impact.
I had a question for you, Dennis, if you don't mind.
Of course.
Yes.
Yes.
With the contribution that the professional services business makes to the investment trust, if you wanted to make acquisitions in the professional services business, would you be cautious about doing so because you might be taking away what you're contributing to the trust for that acquisition?
Yeah, so what we have to do in that situation is we need to think that this has to produce a return greater than what we think that James can produce with a liquid investment, because you're moving from liquid to illiquid. So there should be a premium on the return that we can earn from doing that. We did exactly that with our company secretarial, but we made a small acquisition there where we took 20 million away from James's portfolio and we put that into the company secretarial business. So we would look to do that from time to time, but our preferred growth route is organic, but we would very selectively do that where we convince ourselves that we can make an outsized return because it becomes a liquid as opposed to liquid.
I had one other question for James, if I may. And you spoke about owning other investment trusts, and you'd added Greencoat. The real estate investment trusts are at huge discounts as well. Yeah. Would you buy real estate investment trusts?
We're going through them all. I think on a real estate one, you have to believe that the management are going to add something over just the asset value, and there are some people that will. There's been a headwind, obviously, and they're on the registers. Some of the people, wealth managers, may be leaving those registers, but that's the opportunity. And there's no, I don't know, I don't think there's a rush, but we're doing work there, and we are buying one or two slowly. It's not going to be a big part of the portfolio. There are 150 stocks. There will be 10 of them in time in investment trusts and REITs. We're probably 4 or 5 at the moment. So, but it's a direction of travel because we're getting big income pickups, we're getting big discounts, and we're not going to be activists. We're long-term investors. Value will out.
Lovely. James, Dennis, thank you very much indeed. Thank you.